The Treasury Department said remaining funds from the so-called TARP program would be focused on helping small businesses and the housing market. Herb Allison is the Treasury official overseeing the program. He testifies before the Congressional TARP Oversight Panel for about an hour and a half.
This hearing of the Congressional Oversight Panel is now in session. I'd like to start by welcoming you, Mr. Allison. The first time you came to see us, you had been in your office for 1 week, and yet already we're full of information. And so we're glad to have you back and hope you'll be able to update us on TARP. As you know, TARP was able to accomplish direct and immediate help for the largest financial institutions, but smaller financial institutions, small businesses, and homeowners facing foreclosure have waited much longer and received much less help. People who funded the bailout, the American taxpayers, are bombarded with news that Wall Street firms that benefited from TARP with windfall quarterly profits are now preparing to reward their executives handsomely with hefty bonuses. That, on the other hand, unemployment remains close to 10%, loan defaults continue to rise, and the foreclosure crisis has no apparent end in sight. I worry, not only because of where we are in this crisis, but that the factors that led us to this crisis have not yet changed. The financial sector that we talked about a year ago as too consolidated, too big to fail, is more consolidated than it was back then. When we talked about toxic assets on the books of the banks, those toxic assets remain on the books of the banks. There's little to inspire confidence in the balance sheets of the banks, and the health of small and mid-sized banks remains a very serious concern. That concern is doubled because they are truly the lifeblood of small business lending. 99 of these banks have failed so far, as you know, and we have more than 400 on the watch list, and many are dangerously overexposed to commercial real estate. We continue to face a grim picture. On regulatory reform, the very rules that will change, that will prevent this crisis from happening again, that process is just starting. So I think taxpayers are concerned about what this means for their economic security. We hope you can provide some answers today and put TARP in the proper context and help us understand where we go from here. The panel's core mission, as always, is to ensure that TARP operates with transparency and accountability. We thank you, we thank your staff for working with us very closely on that, and we look forward to hearing from you today. And now I call on the Deputy Chair, Damon Silvers, for an opening statement.
Thank you, Chairwoman Warren. Good morning. It's a pleasure again and an honor to welcome you, to welcome Herb Allison with us, to be with us. I am very grateful to your willingness both to appear before us in these formal settings and the extent to which you and your staff have been available to the panel informally since you arrived at Treasury. This hearing convenes as the Office of Financial Stability and the Treasury Department and the administration more broadly are undertaking a number of initiatives that appear to be efforts to respond to concerns raised by, among others, this panel regarding the provision of credit to business, particularly small business, the continued excessive and, at least to my mind, somewhat perversely structured executive compensation at major TARP recipient institutions, and finally, as our chair referred to a moment ago, the continued escalation of the home foreclosure crisis. While my sense of these initiatives is that they are all directionally correct, I look forward to hearing today about the scope and design of these initiatives in some greater detail. Now, I also want to compliment you, Assistant Secretary Allison, on the OFS's handling of the cancellation of the Bank of America asset guarantee. Bank of America clearly benefited from the perception on the part of the markets that this guarantee was effectively in place for a time, and it was only appropriate that it should pay a fee for having done so. I don't think it was a foregone conclusion that that would in fact occur, and I attribute that to you and your staff's leadership, and I think you should take some public credit.
Thank you.
However, I remain extremely concerned that as a result of having a strategy with the TARP program that is fundamentally about buying time in the hopes that the financial system will earn its way back to health, that we are at risk of a vicious cycle. Persistent high unemployment, in part generated by the initial financial crisis, breeds more foreclosures and a continuing housing depression, which in turn keeps our major financial institutions weak and causes continued high rates of failures of small banks. Weakness in the banking sector then threatens to act as a powerful headwind, preventing the revival of employment outside those firms that can access the public debt markets. We discussed this matter with Treasury Secretary Geithner when he last appeared before this panel. With this concern in mind, I hope that you will be able to discuss with us, with some specificity, the current state and future prospects of the largest financial institutions that are continuing recipients of TARP assistance, and I believe are at the core of the threat of continued headwinds from the financial sector, those being AIG, Citigroup, Bank of America, and Wells Fargo. I recognize, of course, that AIG is a special case. Ultimately, the Wall Street bonuses that get so much attention this past week make tangible and specific the growing feeling among the public that we are back to business as usual on Wall Street, while the financial system is failing to play its proper role in supporting the real economy on Main Street. I am interested in the immediate steps Treasury is taking to counter this perception in areas like executive pay, but the real test will be whether we really repair the banking system so that it can function again, or whether we repeat the unpleasant experience of long-term economic stagnation Japan went through in the 1990s. Again, I look forward to hearing from your testimony this morning, and I again extend my thanks to you for joining us once again.
Superintendent Neiman.
Thanks. Mr. Allison, thank you very much for being here today. You know more than anyone how important today's hearing is to the American public. It was about a year ago that the U.S. government told the American taxpayer that the financial system faced possible collapse if taxpayers did not provide $700 billion to rescue it. The taxpayers did what was asked, and they did it even though it meant swallowing what some perceive as a very bitter pill. I also don't have to tell you about the reluctance and in some cases the outrage of providing financial support to some of the very institutions that helped cause the crisis, many of which pay their employees more money in 1 year than many Americans make in a lifetime. So the stakes of the effectiveness of Treasury's use of that $700 billion are very high. Treasury's programs have to work to stabilize the financial system, but they also have to work so people feel they have also gained from this massive capital infusion. Treasury's programs must restore credit for small businesses that promote entrepreneurship and create jobs. And the programs must keep people in their homes by preventing avoidable foreclosures. Success in these endeavors goes beyond just restoring confidence in our financial system. Success is critical to maintaining confidence in our democratic system. Remembering back to our first meeting with Secretary Geithner in April, I'm glad to say that we can have a different conversation today than we had then. The Department of Treasury deserves credit for making substantial progress. We are by no means out of this crisis, but yours and Secretary Geithner's efforts averted a disaster, and that should be recognized. But our gains remain fragile, particularly as they apply to the people who need Treasury's programs the most. As you and I discussed in our last meeting together over the summer, it is critical that we redouble our efforts to help the millions of homeowners facing foreclosures. I am grateful to the Treasury and to you personally for participating and arranging the participants at the hearing last month in Philadelphia. It was the first time, to my knowledge, that Treasury, Fannie Mae, and Freddie Mac came together in a public forum with housing advocates and mortgage lenders to discuss the progress of the administration's foreclosure prevention programs. I intend to follow up on several of the issues that came out of that hearing with you today. I also intend to ask you about improving access to credit for tens of thousands of small businesses that employ the vast majority of our economy's workers. I'd like to commend your office and the administration for announcing initiatives just yesterday to provide capital for community banks that are substantial lenders to small businesses. 1 year later, the financial system needs to start working better for small businesses and for all Americans. I look forward to our discussion.
Thank you, Superintendent Neiman. Congressman Hensarling, I hope will be able to join us later, and Mr. Atkins, our fifth panelist, is traveling and not able to be with us today. So that concludes the opening remarks of the panel. Mr. Allison, I recognize you for 5 minutes. Your entire written statement will be made part of the record, but if you could take a little time, no more than 5 minutes, to bring us up to date, I think that would be helpful.
Thank you very much, Chair Warren and members of the panel. Thank you for the opportunity to testify today. I welcome this occasion to update you about the progress we made in restoring financial stability and to discuss the impact of TARP programs. The government actions taken last year, including the first phase of TARP, are widely acknowledged as helping to avert catastrophic failure of our financial system. When President Obama took office, the financial system was still extremely fragile, and the economy was contracting rapidly. Measures taken by the Congress and this administration have helped bring stability to our financial system, are assisting responsible homeowners, and are getting credit flowing to consumers and businesses, all at a lower cost to taxpayers than was anticipated. With these improvements, it is time to set a new direction for TARP. We will begin to wind down and terminate TARP programs that were launched at the peak of the financial crisis, and cap programs to purchase legacy assets and to securitize credit at lower levels than anticipated. Now the administration will reshape targeted assistance to the key challenges of helping responsible families keep their homes and helping small businesses get better access to credit. Yesterday, President Obama announced new steps to improve access to credit for small businesses by providing lower-cost capital to community banks. Small business lending represents 56% of business loans from small banks, compared to only 21% from larger banks. Therefore, community banks with less than $1 billion in assets will be eligible to receive new capital at an initial dividend rate of 3% when submitting a plan to increase small business lending. The corresponding rate will be 2% for community development financial institutions. In the coming weeks, Treasury will work with community banks and the small business community to finalize program terms to best support small business lending. The other continuing focus will be our efforts to help responsible homeowners. Treasury's Home Affordable Modification Program has now provided immediate relief to more than 500,000 homeowners who've entered into trial mortgage modifications. Families in permanent modifications are saving over $500 a month on average, as this panel noted in its October 9th report, an assessment of foreclosure mitigation efforts after 6 months. The panel made a number of findings and recommendations in that report. I've tried to address them in my written statement, so we'll only touch on 2 of them now. First, the panel recommended several areas to improve HAMP effectiveness and transparency. Treasury recently released guidance that streamlines and standardizes the paperwork needed for a modification. To make the process more transparent for borrowers who've been turned down for a modification, we've established denial codes that require servicers to report the reason in writing to Treasury and soon to borrowers as well. We're also improving transparency of the net present value, or NPV model, a key component of eligibility, by increasing public access to the NPV methodology and encouraging a wider understanding of the model among housing counselors and borrowers. Second, the panel recommended that making home affordable should try to address a wider population, including borrowers with option ARM loans with negative equity and those who are unemployed. Treasury recognizes that these situations can be particularly challenging. As the panel's report reflected, our current program does permit borrowers with pay option ARMs to use HAMP when they meet other eligibility criteria. HAMP can also help homeowners with negative equity to reduce their mortgage payments to affordable levels with a hope for homeowners refinance from the servicer if the borrower qualifies. Finally, as the recession deepened, unemployment became an increasing contributor to the ongoing foreclosure crisis. Therefore, unemployed borrowers that will receive at least 9 months of unemployment benefits are eligible for a modification under HAMP. As our efforts progress, we will continue to study ways to meet the challenges of reducing total foreclosures. We're pleased to be winding down certain TARP programs, but recognize there are lingering weaknesses in housing markets and small business lending. We remain committed to helping American families and small businesses and building a broad economic recovery. Thank you, and I look forward to answering your questions.
Thank you, Assistant Secretary Allison. We appreciate your remarks. I must say I am encouraged to hear that Treasury is talking about winding down large parts of this program and shifting much of its focus to foreclosures and small business lending. I will be even happier in the day when we're put out of business because this process is complete and there is no more TARP. But this also changes oversight, obviously. We have to go where you go. So let me focus first on foreclosure and the foreclosure mitigation programs, if I can. I just want to make sure that we're kind of tracking here. We put the numbers together, as you saw in the report, suggesting that the current mortgage foreclosure mitigation program or programs, when they're fully operational based on the most optimistic assumptions that Treasury has given us, that nonetheless foreclosures will likely outrun modifications by about 2 to 1. Does that fit with the numbers you're seeing?
Thanks for the question, Chair Warren. I think we have to keep in mind that this program, Making Home Affordable, was designed to help people who are in their primary homes. And these are working Americans. The program was not designed for second homes or investment homes. And so one has to look at the foreclosure rate among the eligible population. And we believe we made great strides in at least today matching the rate of foreclosures in those, or potential foreclosures in that category with trial modifications.
I understand the point, but surely you're not suggesting that the half of all people, even on the most optimistic assumptions, who are still going to lose homes are all investors and vacation homeowners. I understand you've tried to target more. Right. There will still be a substantial number of homeowners who will be left out of the program. Is that right? I just want to make sure that we're dealing with the same set of numbers here.
Well, we are obviously trying to reach as many people as we can in this program. We are now able to reduce the debt-to-income ratios of people who qualify from above 38% all the way down to 31%. So we're reaching a very large number of people. There are some people who will not qualify for this program. For instance, if you have a jumbo mortgage, you don't qualify for the program.
I understand.
Or people with extremely low incomes can receive other forms of relief. But this program will be able to serve, we think, a very large number of working Americans who are having trouble staying in their homes.
So then let me see if I can understand this the other way. You give many reasons why there still may be many foreclosures. But if we think of this problem from a step-back perspective, and that is the problem of dealing with foreclosures in our economy, the impact on neighbors, the impact on communities, we can still expect substantial numbers of foreclosures over the next few years?
Well, actually, there are other measures underway as well. Under the ARA legislation, about $12 billion has been appropriated to help especially distressed neighborhoods where many people are at risk of losing their homes. So there are a number of other programs, in addition to the HAMP program, that have been instituted by the Obama administration to try to deal with the broader housing crisis that the country is facing.
So let me just, then if I can, I want to drill in a little bit on the principal program here, though, for homeowners. And that is, Treasury has estimated that it will bring 500, or in fact has announced that it has brought 500,000 homeowners into the first program, into the HAMP program. Now, of that 500,000 who are brought in, those are people who just have what are called temporary modifications that last for only 3 months. What is the rate at which those people are making it into what are called permanent modifications?
Let me first say that we have extended the trial mod period up to 60 days for people who are having difficulty submitting their paperwork. And we're doing our best to streamline the paperwork so that more people can get through this process and receive a permanent mod.
And we are very glad to see those changes. We are very pleased.
Thanks.
But the question is, of the 500,000, how many are likely to make it into permanent modifications? What are your numbers so far, and what are your projections?
Well, so far the numbers are low because we're still in the trial period for most of these people. And it's going to be some months, I'd say sometime in the first quarter of next year, before we have a really good idea of what the statistically what the conversion rate seems to be.
Oh, but I thought they were only in the trial part for 3 months. So why can't we tell it on the 91st day how many people are making it into permanent modifications?
As I mentioned, we've actually extended that trial period for many people to 5 months.
To 5. All right. So I'll just do the math. At 151st day, why is it that we can't tell what the permanent, the conversion rate is to permanent modifications?
The reason is there are small numbers to date. Okay, we have about less than 10,000 people who have moved into permanent modifications out of the 500,000 because the program is ramped up rapidly, and given the 3 to 5 month delay before they are given a permanent mod.
All right, but from this point going forward, it can't take you more than a couple of months. I mean, they're into the pipeline.
That's right, and that a couple of months, and we'll be into the new year. So we're figuring that early in the new year, we'll have a much better idea statistically of how many people are moving from trial to permanent mods. Now, let me say, our biggest concern of the program right now is making sure that as many people as possible are able to convert to a permanent modification.
Are you using any projections on this number? Surely Treasury is doing its own modeling and using some internal projections.
Yes. Well, we had projections before the program even started. Now what we're interested in are what are the actual rates.
So what were your projections?
Well, the projections were...
From temporary to permanent.
Yeah. The projections were very rough at the time.
What were they?
They were... it depended on the type of individual we're talking about, so it was a very complex set of calculations.
But you had a number.
I wouldn't go with any one number
so give me a range of numbers.
Well, as you know, in the past, the rate of, in different types of programs where there weren't actual deep reductions in expenses, the rates could be as low as 50%. We were expecting that because of the nature of these modifications, which have not been done before on a large scale, that is, where there are meaningful large reductions in people's monthly payments, there aren't good statistics.
I understand, but you have designed the program, so you surely must have some model. How many people is Treasury projecting will make it from these temporary short-term modifications into a so-called permanent modification?
Well, the estimate is significantly more than 50%, but I don't want to place overdue emphasis on any one number.
Surely you all are using a model internally. You're not using a model that says significantly more than 50. You must have a number.
The reason is, as you know, models are simply models, and they don't reflect reality.
I know, so I'm asking just a model number.
It was ranging up to 75%, somewhere between 50 and 75. Okay? But again, the real issue...
That wasn't so painful.
The real issue for America, because I don't want to give overdue emphasis to any one particular number, because I think we can focus on the wrong thing.
But you do understand, to engage in oversight, we need to understand your numbers and the projections here so we can see if this is working even on your assumptions.
The real issue, though, is converting people as fully as possible to the permanent modifications. And that's why we're taking these steps. To try to make it simpler. Now, last week, we brought in again the main servicers in this program, and we sat down with them to focus on the issue of trying to increase conversion rates and maximizing those. And we've also told them that we're going to start publishing service metrics for the servicers starting in early December. And they'll include measures such as how long does it take between the time that someone applies for a modification and the time they actually receive a permanent modification. How long does it take for the servicers to answer the phone and provide answers to people who are very concerned about whether they'll qualify or not? So we're trying to...
You'll be naming names.
We will be naming names. We'll be naming individual banks against more than 5 of these different service measures starting in early December. The banks are on notice. And we think by providing sunlight on the data around services that these banks will try even harder to meet the highest standard.
Thank you. I look forward to it. I apologize to both of you, and I will skip my next round of questions if need be. Mr. Silvers.
Thank you. I'm all for thoroughness, so you got no problem with me. Assistant Secretary Allison, you've heard a bit about mortgages. I understand my colleague Superintendent Neiman is going to talk to you a bit about small business. I would like to focus on very big business, but don't take that as a lack of interest in the other 2 subjects. Yesterday, I think, although it's a little hard to tell the combination of official announcements and leaks, but it appears that yesterday the pay czar, Ken Feinberg, announced a plan to require that the very largest recipients of TARP funds cut their executive pay significantly, particularly in relation to the cash component of that pay. There have been some anonymous quotes in the press this morning from executives at these firms pointing out that a lot of what Mr. Feinberg has in mind is to shift that pay toward long-term compensation, equity-based compensation. I hope you'll tell me if what I'm saying is not true. I'm gleaning it from the published accounts. The concern I have about, there's a concern I want you to address about this, which goes right to the statements that have been made by the Federal Reserve about the proper way to do executive pay in financial institutions. On the one hand, it appears that Mr. Feinberg is moving in the direction of lengthening the time horizons of pay, and I think that's a very good idea. On the other hand, I'm very concerned, and I would like you to address the question of whether or not we've got the risk element here properly correct, in the context of, particularly in the context of banks with very low stock prices, that in pushing pay into equity form, where the stock price is low, it's not clear these folks really have that much downside exposure. And so as a result, I'm concerned that we are incentivizing a certain amount of risk-taking with the public's money as a backstop. And I wonder if you could comment on that.
Well, first of all, as you know, the Special Master will soon be announcing his compensation determinations, and will be explaining to the public how he made those determinations. So I'll leave some of that explaining to him. And he has operated in a very independent way. He's making his own decisions. But it is important, first of all, that we protect the interests of the taxpayers who've invested so much of their money into these companies over the past year. And so these programs are being designed in a way that will provide that most of the pay will be long-term in nature. Some of the pay will be conditioned on returning TARP money to the taxpayers. They're designed to discourage excessive risk-taking. At the same time, under the interim final rule that governs the Special Master, he's encouraged to keep in mind the need for the long-term survival and competitiveness of these institutions in the interest of taxpayers getting their money back, but also to make sure that the pay is not excessive and take away from the overall profitability of the banks and their ability to rebuild capital.
I guess my question, let me hold my question. If you pay an executive I think this problem is most severe at Citi and potentially at AIG, depending on exactly what the Special Master does. Mm-hmm. If you pay an executive at Citi with a package that is stock-based primarily, the stock is at $4, right, as I believe it is roughly today. There's just not that much downside in that package, right? And what downside there is going to be absorbed, frankly, by us, by the public, because I mean, we all know that if Citi takes large losses, the pressure to try to do something on the part of the government will be profound. What is your view? I know you're not the special master, but you are in front of us today. What is your view as to how we avoid a situation where those people have all the upside of risk but none of the downside?
Well, let me first of all say that, as you know, the United States government is a significant shareholder in Citigroup. And so what we're doing now is aligning the interests of those employees with the interests of taxpayers. And if the stock price of Citigroup does go up, the American taxpayer will benefit as well.
I'm worried about what happens if it goes down, because there's no, if you're thinking about this from the perspective, we have the downside, right? They do not. They, being the executives, we're incentivizing. What do we, I recognize it's not a simple problem to solve in compensation design, but I want you to focus on it.
Well, sir, the executives do have considerable downside because, as you mentioned, much of their pay is paid out over the long term and is dependent upon performance metrics, including the stock price.
But you recognize, do you not, that the downside for the executive is capped at zero, at the value, when the value of the stock hits zero, that's as low as they can go. We will take the rest of it, and it's the full value of all Citi's liabilities potentially.
Well, first of all, these banks did undergo the stress test last spring. They raised a considerable amount of equity capital. In fact, the total raised by the large banks was about $80 billion. Their capital positions are far better today than they were then, thanks to the stress test initiated by the Secretary of the Treasury and conducted by the Fed and other regulators. So I think the banks are in a much stronger position today, and we hope in a position to start repaying the federal government before too long.
My time has expired. I'll pass on.
Thank you.
Thank you. Mr. Neiman?
Thank you. So I would like to come back to the initiatives to enhance and promote small business lending that were announced yesterday. I was pleased to see the inclusion of capital for smaller community banks who provide a substantial amount of credit to small businesses. I was particularly pleased to see that the extension of capital to community banks is contingent on a submission of a business plan to demonstrate the amount and type of lending, where that lending would go to support small businesses, and that there would be a follow-up requirement of quarterly reporting detailing those lending transactions. I think you wouldn't be surprised that many of us would have liked to have seen a similar contingency and requirements earlier in the CPP when that was announced by the prior administration. There are a number of questions that I think still remain, and many which I think you acknowledge that final decisions that will take time as you roll out the specifics of the program. But some of the questions I have, and there seems to be some inconsistent reports in the press as to, are there, in addition to the 3% dividend, are there other charges for the capital that will be provided to the banks? For example, will there be the requirement of issuing warrants? There was a report in the American Banker today that it would include warrants.
Well, there is a de minimis exception for issuing warrants, and the exception is banks that receive less than $100 million. Virtually every bank in this program would be receiving less than $100 million. Now, these have yet to be fully worked out. We're going to be issuing detailed guidance on this program after we discuss the program features with the banks as well as small business. But it is very likely that these banks will not be subjected to the same degree of a warrant requirement as was in the case of CPP for the larger banks, for example.
Now, one of the other program provisions is modeled after the CPP program that requires that it be based on a determination that the institution is deemed viable without the capital.
Right.
Have you or the administration considered modifying that program to permit, under certain circumstances, banks that would be deemed to be viable after receipt of that capital? Yeah. What we're seeing and what we've heard from others is that in order to attract private capital determination by the administration that an institution is not viable serves as a red letter to discourage private capital. So I'd be interested if you had considered under certain circumstances. It's my understanding, in fact, that FDR's program did have specific categories of those banks that would be viable without, and those banks that would be viable only after a contribution of capital.
Yeah. Well, first of all, we want to make sure that the capital is used for the intention of the program to stimulate lending, and not simply to fill a capital hole on the bank's balance sheet that won't produce additional lending. And so we believe that, and we've considered this issue very carefully, Commissioner Neiman, because we've been asked this question many times, and it's an important question. But we believe that this program, to be most effective, should be aimed at viable banks so they can use the additional capital to promote lending. And with the additional capital, they can leverage that capital and lend quite a bit more than the amount of the capital itself. Secondly, we have to, of course, protect the interests of taxpayers. And so their interests are better protected if we are lending to viable banks. And there are a very large number of these. By the way, this program covers about 91% of all the banks in America, about 7,500 banks. So it is a very broad program. But we think that for it to be most effective, every dollar of this additional capital should go to additional lending.
So there was internal discussion and analysis of whether that viability test should be reconsidered?
Yes, sir. There was.
And was there the same analysis and discussion around the $1 billion cap? Should it be increased to $5 billion, and what you would pick up in turn, or even $10 billion in terms of the contributions to small business lending?
We did consider that very carefully for a number of months, actually. And we determined that because of the outsized role that these small community banks place, not so small, up to $1 billion of assets. Because of their outside role, we think it's important to direct the funding to them, and they have the highest rates of small business lending of all the different segments of banks. So we think this is the best use of taxpayers' dollars to get this economy rolling, especially in communities all across the country.
Do you have an estimation of the timing? There's been a clear, level of concern around the number of banks and the time it has taken to process these applications. Do you expect that these will be approved by the end of the year, or will it be determined? Will it be dependent on whether the TARP program is extended beyond the end of the year?
Well, the good news is we have the infrastructure for this program already in place. We don't have to build it. We can use the existing capital purchase program infrastructure. We have the procedures and the policies largely in place already, so we can roll this program out very rapidly. We're anxious to get going. We want to meet with bankers and small business people just as soon as we can to finalize the program and then get it moving. So we feel a sense of urgency to roll this out rapidly.
Any estimates on the timing of receipt of applications?
Well, we want to begin to take the applications very soon. I can't give you an exact date when we'll be doing that, but we'll be announcing that very shortly.
Thank you.
Thank you.
Thank you. Okay, I'm still on the hunt for some numbers on foreclosure.
Right.
So I want to make sure I understand this. We talk about the HAMP program, 500,000 people into it by mid-October. We raised the question about whether or not this will be enough to slow down the rate of foreclosures so that we can get some stabilization in the housing market. We then ask of the people who come in, the 500,000, just to use that example, of the people who come into the program, how many will make it into permanent modifications? And you said somewhere between a quarter and a half are unlikely to. So I want to ask the next part, and that is, of the people who make it into so-called permanent modifications, what are Treasury's projections on how many people will actually be able to make those payments and still be in those houses at the end of the 5-year period and make the transition back into their permanent mortgages? In other words, the question, I just want to draw as fine a point on it as I can, are we preventing foreclosures or are we simply delaying them?
Well, first of all, I'd like to correct the record on this. I did not say that we expect that 1/4 to a half will not be converted.
I thought that was our
No,
50 to 75% success rate.
What
I was doing the math the other way.
What I was saying was that we had looked at some modeling last winter and early spring. In fact, it was before I arrived, okay, to try to estimate the size of this program. What we're interested now that we're actually operating and growing very rapidly is looking at the actual conversion rates and trying to maximize those as much as possible. So I'm not prepared to say what we think the rate will be of successful conversions. All I can say is that we'll have much better information and much better estimates based on real experience by early in the first quarter.
Right. But you are also not telling me that Treasury is flying here with no projections on how this program works in terms of numbers. You can't be telling me that. There must be projections on how this program will work.
Well, what we've projected is that we'll be able to do within the 3-year period of this program, when we're actively bringing people in and modifying mortgages, we expect to be able to succeed with about 3 to 4 million people.
Okay, so
right, which is a very large portion. We also believe already, given the eligible population of people for this program today, that we're about keeping pace, at least, and maybe ahead of the foreclosure rate for that population.
You don't mean foreclosure filings, you mean because the foreclosure filings are accelerating.
What I mean is what the rate would be without this program.
Well,
okay? And so I think we're making tremendous progress. Now, we're not satisfied with the place we're at today. We're working with the servicers to increase as much as possible the rate of trial modification. Some banks still have a long way to go to reach their eligible populations here. We want them to move as rapidly as possible. And then the challenge is going to be, and you're absolutely right, and we are very concerned about this, the challenge is to minimize the failure rate of getting people from a trial modification to an actual modification.
So let me ask so that I don't have to run 4 minutes over again.
Okay.
What projection is Treasury using for the proportion of homeowners who will be able to make it from a trial modification to a permanent modification?
Well, again, we would like to have as many people as possible, and it may be, you know, if we were to achieve.
And I would like all the children to be above average, but that's not the world we live in. You must have a projection here.
What I'm trying to say is I think if we can get this rate to something like 3/4, that is a very ambitious success rate.
So are you telling me that that's what you're projecting? As you're working this program out, you must have a projection for what number you're using for the conversion rate from temporary modifications to permanent modifications. Treasury must. You can't have a program for which you're not projecting how many people will be in it and how many will be in at each stage. So the question I'm asking is, what is your projection on the proportion that will make it from temporary modifications to permanent modifications so that we can evaluate this program, whether or not it's likely big enough to deal with the problem?
Right. Again, based on past experience with different types of modifications which were not materially reducing people's monthly payments, you saw a failure rate of about 50%. So we could use that as a bare minimum success rate, but we'd like to achieve a much higher rate. If we were to get to something like 75, which is an aspiration, we would deem this quite a successful program.
So I just want to make sure I'm understanding them. The projection is that the floor will be that you'll have at least 50% of those who get into a trial modification will make it, I'm sorry, I did the wrong one. 50% of those who make it into a permanent modification will actually be able to make their mortgage payments for 5 years.
No. What I'm saying is we would say that the bare minimum of getting from a trial mod to an actual mod, okay, should be above, and then the failure rate.
And then, I'm sorry, and I also confused it.
Yes.
I confused it.
I understand.
The redefault rate, the rate at which those people who get these so-called permanent modifications actually stay in their homes for at least 5 years, and we are not simply delaying foreclosures, we're actually preventing them. What's the rate there? How many people who make it to permanent modifications does Treasury anticipate will actually be able to pay those mortgages?
Well, I think there again, there isn't a good past set of evidence for a program like this, all right? Because what is so important about the program is that we're materially reducing people's payments.
I understand, right? And the panel has been quite complimentary about the approach.
Right.
The question is, what's the number you're using in your projection? Of those who make it to permanent modifications, what proportion, in fact, will still end up in foreclosure?
Well, we're really not sure what proportion will end
You
up
must
in
have a
foreclosure.
projection. You must. We all have looked at numbers. We've been looking at numbers now for a year in terms of what are called redefault rates. That is, people who got a modification and then it doesn't work.
Yeah.
You must have a projection for this. Treasury has put this program forward. What's the projection you're using? Based on all the data you've read, I understand the programs are different. I understand there are lots of different studies that use lots of different information.
Right.
What's your projection?
Well, I think, again, what I can do is to come back to the panel with our best estimate on what that might be, all right? But I think, again, our goal is to get beyond the projections to reach real Americans who are in trouble and try to have as many of them succeed in this program as possible.
I'm sure that's everyone's goal. Mr. Silvers?
This is Secretary Allison. Can you tell us how large, what is the dollar amount assigned to the small business program you were discussing with Superintendent Neiman a moment ago?
Well, at this point, we are going to be working with the communities that are going to be helped by this program to try to estimate the take-up rate for it. And so we'll be in a better position to estimate for you what the actual expenditure might be once we've completed that work, because we're going to try to tailor the program as much as we can to the actual needs. Instead of designing the program in the abstract and finalizing every aspect of it and then rolling it out, we've announced the broad metrics of the program, and now we want to work with them to see how we can maximize the take-up, and then we'll be able to give you a better estimate.
We are using TARP money here, right?
Yes, we are.
Right. So it can't be more than the amount of TARP money that's left.
Absolutely correct. Yes, sir.
Can you give me any further insight into your thinking as to what the range might be? I don't want to get into a 10-minute discussion of it, but I'm interested.
Yeah.
Can you scale it for me in any respect?
Yeah. Well, it would be a fraction of the amount of remaining money. I would say it would be somewhere between $10 billion and as much as $50 billion.
That's very helpful.
And the answer could be somewhere in between. And again, what we want to do responsibly here with using taxpayers' money is to provide as accurate an estimate as possible.
There have been some suggestions. I believe Senator Warner in particular suggested the idea of essentially, as we have done in some of the credit markets, just effectively bypassing the bank credit system and moving TARP money directly to small business with private sector managers.
Yes, right.
Can you explain to me why you thought you appear to have decided to go this route instead of that route?
Yeah. We've decided to go through the community banks because we think that's by far the most effective and efficient way of reaching large numbers of small businesses, because these banks already have relationships with these companies throughout the country.
Oh, yeah, no, that's not the question. I think the proposal Senator Warner had was actually to go through those same banks. The issue was whether or not the way you're proposing to do it is you're going to give the banks some equity capital, and then they're going to give you a plan. For how they're going to lend, you assume that money plus other money to small business. Yeah,
it's actually, if I may say, it's in reverse. They're going to give us the plan, then we're going to give them the money.
Right. No, I wasn't implying an order.
Right.
You have to have a certain confidence that they're actually going to do that, and not, as you suggested, your concern might be that they were going to fill capital holes and the like. Right. On the other hand, if you did what you did, what was done with TARP in the more financialized markets, which was to go directly into those markets, right, in the TALF program.
I see.
Right. Senator Warner was talking about going directly into the small business lending market, hiring the community banks to manage it for you, but thereby ensuring that the money, in fact, ended up where you wanted it to end up. I'm just curious that you made a choice to use the bank's capital structure, not just their managerial capacity, but their capital structure.
Right. And the reason is because by providing capital, they can leverage the capital to do much more lending.
Right.
Perhaps 8 to 10 times the amount of the capital can be lent out.
So your hope is that, for example, just take a number, that if you put $25 billion into this, that you might be able to generate between $1 and $200 billion of net.
That's correct. Yes,
that's the hope.
That's right.
All right, well, that's.
Yes.
I think that's very thoughtful.
Okay. Thank you.
The let me shift back for a moment to big business. When our last round ended, you were telling me about the perception, the Treasury's belief of the growing strength of the large banking sector. I'm curious if each of Wells Fargo, Citi, and B of A showed up this morning with a check for the balance of their TARP funds, would you accept it?
Well, first of all, that's really a matter for the regulators to determine, first of all, because they're responsible for the financial soundness of those institutions.
All right. I hope you would correct me if I'm wrong. My perception is that at least Wells Fargo of those three banks has almost begged in public to be allowed to return the money, and which suggests that they've got the check, and yet they're not being allowed to return it. Why, in your view, is that so?
Well, again, I wouldn't speak for the regulators of Wells Fargo, so I would defer to them and their determination of whether Wells Fargo is ready to repay. Obviously, on behalf of the taxpayers, we'd be delighted to receive our money back from these banks, but we also have to recognize that the money was put out there to enhance financial stability. The regulators are far better qualified than the U.S. Treasury Department as to when those banks will be able to repay.
If I can ask the indulgence of my fellow panelists, just to express a final thought here. It seems to me that you and the regulators are behaving wisely here. That this is the real test of whether or not we have repaired our large financial institutions, is whether or not, in the privacy of whatever rooms that these decisions are made, people, fully informed individuals, presumably acting in good faith with the public interest in mind, are willing to allow these banks to return the money. And I think the decision, the evident fact that they have not returned the money, suggests that, in truth, there's not a comfort level with doing that. I think that's very good. I would urge you not to submit to any kind of pressure to allow banks that are fundamentally not yet sound to return the money. But I think it raises a larger issue, which goes back to my concerns in my opening statement, and to the backdrop to your views about the weakness of the small business lending market, and to the backdrop to the sort of end game around mortgages, which is these institutions do not appear to really be healthy. And that's a very dangerous thing, given the size of those institutions. And it seems to me that that remains a continuing challenge.
Mr. Silvers, first of all, these banks have raised large amounts of capital, in some cases very large amounts of capital since last spring, since the stress test. They are far better capitalized than they were then. And so they're in a better position to begin considering, I think, repayment. But the regulators have to be the arbiters of that. And, of course, we're in dialogue with the regulators as well. So I wouldn't characterize these banks as being impaired today. I think they're far healthier than they were before. And they have made they've taken a number of steps to reduce risk on their balance sheets as well. So I think the day is nearing when they'll be able to begin repaying. Certainly a lot closer than it was last spring.
My time is far expired.
Mr. Neiman?
Thanks. So I had intended to use this round of questionings to focus on conversion rates from trial mods to permanence and redefaults. But considering the time we spent on that, I'll just make a few points that, in my additional views in the October report, I did note that it was, in my opinion, it was too early to calculate those conversions, and because of the very low statistics, could be skewed for a number of reasons. However, I think those kinds of projections would be helpful, and there are already press reports. B of A has been reported in the New York Times that they have estimated a 50% conversion rate. So I was going to frame my question that it would be helpful to Treasury to provide its own guidance. My question was going to be, when do you expect to be in a position to project conversion rates and redefault rates and ongoing volumes for HAMP?
Yeah. First of all, again, we're trying to continually improve this program to increase the conversion rates. And we are going to be, as I mentioned before, in a better position to estimate what the goals for conversion should be when we have further experience and have made further improvements in the program, and that should be early in the first quarter. And I think we'll be revising those estimates as we go forward, gain more experience, and provide further improvements to the program.
Now, also in the October report, and you responded briefly to the issue in your written testimony, we pointed out that the administration's housing foreclosure prevention program was designed 6 to 8 months ago, and unemployment has continued to grow since then, and the crisis has certainly extended, and foreclosures extended from subprime into prime. So my question is really focusing on what is the Treasury doing on the issue of targeted foreclosure relief for the recently unemployed? I've suggested both in our last report and in other meetings with you and personally with the Secretary to explore federal funding for state programs that are modeled after Pennsylvania's successful program, a HEMAP program, Housing Emergency Mortgage Assistance program that provides, in a sense, short-term secured bridge loans for people who are recently unemployed. A program of this nature could be funded either possibly through TARP or through legislation. So my question is there a reason not to pursue this approach to explore whether TARP or legislative proposals, which is my understanding there are some that have been proposed on the Hill, should not be pursued as part of the administration's program?
We are familiar with the Pennsylvania program, and we have high regard for what's been done in Pennsylvania, and a number of other states have initiated foreclosure prevention measures as well. Let me mention again that our own program now allows people to qualify who have expected unemployment payments for at least 9 months to come. We are still studying what more we might do in that area. We think that our program, as it's designed today, is the most efficient one to reach a large number of people and also to protect taxpayer dollars at the same time. But we're open to suggestions, as we have been all along. We are looking further at the Pennsylvania model as well to see what more might be done.
So do you
let me also mention that there are other federal programs underway, such as for state housing finance agencies, for cities or other areas that are impacted more than average. Already these programs are in place, so we can't look just at the HAMP program as the total. Let me also mention that outside of the TARP program, the government-sponsored entities, Freddie Mac and Fannie Mae, also have their own program, which is identical to ours, to reach their borrowers as well.
Well, to the extent that the analysis around that program continues and a decision is made one way or another, I would appreciate it if you would get back to our panel once a decision or provide us any analysis or decisioning around it.
Thank you. We will.
Thank you.
Thank you. Actually, I'm going to start by following up on the previous 2 lines of question. I just want to make sure, in following on Mr. Silver's question, as I understand it, in the small business lending, you'll be asking the banks to propose plans for using this money, which I think is a substantial advance over where we were a year ago. But I just want to make sure, unlike the TARP funding for the big banks a year ago, this time will we be tracking the money?
Well, first of all, with the program that already exists, the capital purchase program, we have voluminous information on our website, financialstability.gov, about the actual lending by all these banks. And we think it's very important that the public be able to see for themselves. What's really important is how much lending are they doing. We also have indications that this program has been quite successful in producing lending rates in the banks that are higher than they would have been without the program. So we think we're being quite transparent about actual lending activity. And so for this program as well, we want to be reporting on the actual lending being done by these banks.
That was not my question.
And what, in terms of tracking how the money is being utilized, we're asking the banks that'll be taking part in this program to give us their goals. And we'll be looking at their goals, and then we'll be measuring the performance, for instance, in lending, which is the main objective of the program, in a way that the American public can judge for themselves how each of these banks is performing.
So we will be verifying that they use the tax dollars for small business lending.
They'll be verifying.
We'll look at their lending rates before they take the money.
That's correct.
And we should expect to see essentially
exactly right.
Either a dollar-for-dollar improvement in their lending, or with leverage from private investment, a better than dollar-for-dollar improvement in small business lending.
Absolutely. We hope there is a better than dollar-to-dollar, but I think the important point is to judge them against the plans that they submit as to how much additional lending they're doing, which should be more than the dollars we're putting into the banks.
All right, and we'll be documenting that.
Yes, ma'am.
That sounds good.
Okay.
That sounds very good.
Thank you.
All right. And let me ask a follow-up to Mr. Neiman's question. We were talking about all these programs, the various programs, some obviously underway on mortgage foreclosure mitigation, some perhaps in the wings to try to deal with the problem. I just want to ask about the other half. These are all questions about using taxpayer money in order to bail out homeowners, and in particular the investors who bought those mortgages, who invested in those mortgages for high profits. How much are we talking about programs where the investors have to acknowledge their losses and come to the economically rational place in dealing with foreclosures? I worry about two facts. The evidence suggests that $120,000 is lost in every mortgage foreclosure. That would seem to me to be an enormous incentive for the mortgage lenders themselves, frankly with no government help, to come in and modify those mortgages. But the second part is, for every dollar of federal money that goes in and ultimately makes it into the hands of the mortgage lenders, there's an increased incentive for them to sit on the sidelines and hope that more federal dollars are coming and not come to the table and negotiate with their homeowners. So I just want to hear about the part of the program that encourages the lenders to acknowledge their losses rather than taxpayers having to pick that up.
First of all, as you point out, foreclosure is very expensive. It's expensive to everybody, to the homeowner as well as to the original lender. We believe that our program, which is designed for situations in which there is a positive net present value to modifying the mortgage, has caused banks to take a hard look at whether they might be better off by modifying the mortgage. And as to principal relief, which is your other question, what are we doing about that? The Making Home Affordable program does allow for principal relief, does provide the same types of incentives. We also have now coupled the Hope for Homeowners program, which involves principal relief, into our waterfall of alternatives. And the folks who run the H4H program are working on revised rules and guidance that will soon be rolled out for that program. So we should see more activity in the Help for Homeowners program as well. In addition, the Obama administration has long advocated responsible reform of bankruptcy rules to bring lenders together with borrowers to try to prevent bankruptcy, which is expensive to all sides, by negotiating an affordable modification in those places.
Thank you. Mr. Silvers?
I want to pick up on this line of questioning a little bit. As Superintendent Neiman mentioned, we had a hearing in Philadelphia, and your office is very helpful in providing witnesses. At that hearing, there was a great deal of focus on these two issues you just mentioned. the question of negative equity and the reform of our bankruptcy laws on the one hand, and secondly, the issue of the unemployed. In respect to the reform of the bankruptcy laws, and I just draw this to your attention, it was acknowledged by our expert witness from the Federal Reserve Bank of Boston, that really the bankruptcy reform was the only way anybody could think of to target relief in the area of negative equity. Right? That there's a problem if you just throw money at negative equity, that it goes to lots of people who can actually afford to pay their mortgages. Right, but that if you have a bankruptcy process, there's a kind of gatekeeper mechanism there. Bankruptcy is unpleasant and has real consequences for the person going bankrupt, but you target the relief that way. Secondly, I want to come back to unemployment. There was a near universal, I think actually universal view among our witnesses that the Treasury's programs did not adequately address the unemployment-driven foreclosure wave. And as Superintendent Neiman suggested, a deep interest in the HEMAP program, the Pennsylvania program. Do I take from your testimony, I want to just be clear that you are looking at further actions in this area. Is that, am I hearing your testimony right?
We've been looking at a wide variety of actions, including to help people who are unemployed. As I mentioned, that this program now makes it possible for people who have the prospect of another 9 months or more of unemployment insurance to take part in the program. And we'll continue to look at what else we might do, and in balancing the interests of the taxpayers with the needs, the very serious needs of people who become unemployed. And we are looking at various models. I'm not committing that we'll be able to instigate any particular method at this point.
I didn't hear you commit.
Actively looking at them.
But you are actively looking.
Absolutely.
I mean, I would urge. I think you know this, but I would urge you to not just consider this as a balance between the interests of the taxpayers and the interests of people facing unemployment and foreclosure, but the systemic consequences of an unemployment-driven foreclosure wave.
This is a very serious problem. The Obama administration takes it very seriously. It's initiated a wide variety of measures, again, beyond the HAMP program. The entire economic stimulus program is intended to create jobs and to preserve jobs as much as possible during the most serious recession we've had in at least 50 years.
You know, at least I personally am aware and supportive of much of that work. I think that the particular program of unemployment, the particular problem of unemployment-driven foreclosures, is one that I think was underestimated through no one's particular fault early on in the development of the Making Home Affordable program, and I'm glad to hear that you're looking at further at what options are available. I urge you to do that.
Thank you, and we certainly understand the importance of this issue.
All right. Very good. I want to then turn back to the small business piece for a moment. There's a trade-off, it seems to me, between the strategy you have taken. There's a trade-off between the potential of leveraging small business lending versus the certainty of a direct TARP pipeline, right? That you'd be certain that that money was going to small business lending if you did it directly. I think that I would urge you to sort of focus on our chair's comments about the need, given the choice you've made, to very closely monitor not just the plan at the front end, but the implementation of the plan at the back end from these banks. So I just wanted to.
Thank you, and we fully agree with you.
Okay, very good. I'll stop here and pass it on to my colleague.
Mr. Neiman?
Thank you. You know, I want to focus on the stress tests and pick up on commercial real estate lending, which we really haven't touched on yet. The stress tests required that the largest banks to carry and in some cases raise additional regulatory capital. When those tests were conducted last spring, many of the concerns revolved around the mark-to-market securities. Now it appears that those securities may have stabilized somewhat, and now the concerns have really shifted to portfolio loans on banks' balance sheets, particularly commercial real estate. Is your office looking at or considering any programs other than PPIP and TALF for CMBS programs, commercial mortgage-backed securities, or an expansion of those programs to address the particular issues around commercial real estate loans?
Let me say that we've looked at many alternatives. This is a problem that is considerable across the country, both because the securitization markets are not as robust as they were before and because banks have a large amount of commercial real estate loans on their books. In fact, the smaller banks tend to have a larger proportion of commercial real estate on their books than do the bigger banks. That's another reason why we've launched this program aimed at community banks, which have a lot of their small business lending is connected with commercial real estate lending as well. So by providing them access to additional capital, we can help them to withstand a deterioration in the value of those assets on their books. Now, we think that providing capital is more efficient and more effective than trying to directly intervene to support prices in the commercial real estate market, which would be very expensive and really impractical. So by providing capital, the banks are better able to deal with the problems on their books by, for instance, extending loans or modifying loans over time. And we think that already there's a lot of creativity in the commercial real estate market. Some investors are coming in. We're seeing somewhat more activity in the securitization markets in pockets. And banks' earnings also can help them to withstand this problem over the next several years. So I think the banks are well aware of the problem, as are the regulators, and they're working actively to deal with it.
Are there any proposals around addressing the commercial real estate problem that you could share with us, particularly problems of projects that support affordable housing, multifamily housing? There are a great concern in many urban areas, including New York, that large commercial lenders who use those funds to purchase low and medium income housing projects, now that they are facing possible defaults, are cutting back on maintenance and services, and is becoming a real community concern. Are there any programs that you can share with us today that may have some level of real interest to confirm that there are programs under consideration?
Well, we have been in dialogues with community leaders and also with housing finance agencies and others to look at this problem. And so overall, there have been measures taken to support the housing finance agencies and to work with them on this problem. And as you know, there are different situations for different housing projects, and in some cases the banks are stepping in to deal with this, or other new investors as well. So there are a variety of ways of dealing with that problem, and but again, right now our focus is going to be on providing capital to the community banks to help them deal with a very widespread issue of commercial real estate and supporting small business, and those two are intertwined in the communities across the country.
Still on the stress test,
right.
Is there any consideration being given to rerunning any of those stress tests on large or regional banks with a particular focus on commercial real estate loans, and to extend the time horizon on those tests out another year? You know, we certainly have utilized, and I've said publicly in New York, we've utilized stress tests on an ad hoc basis in situations where we feel a bank may have issues. But is there any consideration, and we've recommended it in past reports, that the administration and the regulators consider expanding out either on a ad hoc or systemic basis, the stress test?
As you know, the regulators are very well aware of these issues, and they are the ones who determine how to stress test those institutions. And I'm sure that they've had extensive dialogues through their supervisors with these banks to understand what their situation really is.
Okay, thank you. My time's expired.
All right. I'd like to ask some questions about the winding down. I was interested to see that on September 18th, the money market guarantees were permitted to expire. Is the guarantee really gone? The next time money market managers face big losses and the money market account breaks the buck, is there anyone in America who doesn't believe that the American government will rush back in and support the money markets?
Well, first of all, the need for that program went away.
Well, it's gone away for today.
yeah.
I'm asking about tomorrow, the next time we hit a financial crisis. So do we have, in effect, the question I'm asking, do we have, in effect, a free guarantee out there? That is, we won't call it a guarantee in boom times, and when there's a bust, then we'll move in. So unlike FDIC insurance, for example, which you have to pay for all the time, it's just an insurance policy that you pay for only when you're sick.
Yeah. Well, that's another reason why the administration has been proposing comprehensive reform of the financial industry and also adequate disclosure by institutions about their financial situations. So I think that the question that you're asking, is there a moral hazard?
Yes.
The design here, the intention of the administration's programs is to reduce drastically the need for federal intervention going forward.
Through regulatory reform.
Absolutely.
Good. So let me ask another one then. Will CPP, CAP, and TIP, I am learning the acronyms of Washington, will those three programs be closed by the end of the year?
Yeah, let me just mention there's the Capital Purchase Program, the Capital Access Program, and the program for just a few banks.
And the TIP.
The TIP. And
Show off.
That's the Troubled Investment Program. But those programs are in effect going away. They're being capped.
So they will be gone by the end of the year.
At the end of the year.
Are we planning any new programs to launch?
The programs that are planned are the ones that I've talked about today.
Okay. So that means that going forward, just if you could, describe what TARP will be starting in January. What's left?
There'll be, well, we have the homeowners program, first
So
of
the
all.
homeowners program will be ongoing. The new small business lending program.
Small bank program, absolutely. And others will still have the investments that we've made that have not yet been repaid.
But surely we don't need a whole TARP apparatus to be stock
Well, actually, we're going to need people who are looking after those assets, asset managers, as well as accountants.
I'm actually sorry to hear that. We're still not considering the panel recommendation to put those shares of stock in trust. I should say Treasury is still not considering the panel's recommendation to put the shares of stock of the auto industry and the large financial institutions in trust.
Most of our holdings are in preferred stock. We are common stockholders in a few companies.
And the recommendation is to take our common stock and put it in trust.
The ESA law, under the Emergency Economic Stabilization Act, Stimulus Act, the Treasury Secretary has the responsibility for overseeing those investments. He cannot shed that responsibility. Even if we put them in a trust or a limited liability company, the Treasury Secretary still has that responsibility under the law.
So I'm sorry, I'm not quite understanding. Are you saying it's not lawful for the Secretary of Treasury to put the shares of stock in Chrysler and GM into trust?
No, I'm not. I'm saying that even if they are put into a trust vehicle or a limited liability company, the Treasury Secretary still has the responsibility for overseeing those assets. It's possible to do that. The question is whether that's an efficient use of taxpayers' dollars to create that administrative infrastructure, since the Treasury Secretary still has the responsibility for oversight.
All right. Good. I'm going to quit early this time. Mr. Silvers?
Thank you. I want to circle back to where we started about executive pay. Thinking about this, it seems to me that this week we have seen a fair amount of public anger about bonuses in the financial sector, most of which are actually not to top executives, and most of which are across a number of firms, not all of which will be subject to Mr. Feinberg's recommendations. So what do you say to the public, right, who are expressing the view that firms like J.P. Morgan, Goldman Sachs, Morgan Stanley are alive today because of the combination of CPP funds and Federal Reserve dollars, that they have now handed out vast sums to a relatively small number of people, sums that would simply not have been there absent government support. And they are not going to be affected by Mr. Feinberg's recommendations because they apply only to the banks we were discussing earlier. What do we tell the public?
Yeah. Well, the administration and the Treasury Secretary have been outspoken about the need for financial institutions to structure their compensation in ways that promote a long-term view for the health of those companies and responsible risk-taking. And obviously the public is angry about the pay levels in the financial industry among some institutions, not all by any means.
Right.
And I'm sure that the boards and the managements of those institutions must be aware of this. We have also, as you know, imposed the interim final rule on the institutions receiving special assistance from the federal government, and the results of those determinations will be out very shortly. Other banks that are still in the capital purchase program, for instance, and these other programs that we mentioned, are still subject to the rules that govern those companies on compensation as well. And what we need is comprehensive reform of financial institutions, of the regulations that cover them, and boards have to be responsible in making sure that their pay programs are reasonable, that are paying for real economic performance and not just spurts in market prices, and that they're incenting their employees to think about the long term and to manage risks responsibly.
It seems to me that in respect to the bonuses that we just announced, the horse has left the barn. And my question is, would the administration consider looking at tax policy as a way of roping that horse?
Well, I'm sure that the Congress and the administration are equally concerned about this, but I can't speak for tax policy.
Well, some of your colleagues at Treasury, you might want to have a chat together.
I'm sure that others will have more to say about this in the future.
Let me move from that. Earlier this week, Neil Barofsky issued his report as the Special Inspector General. He raised an issue about his report talked about a sort of confidence deficit or something of the like. I forget the exact term he used. And he cited particularly the statements made by your predecessors about the fact that all the banks that were getting CPP money were healthy, and that was clearly not true. I have noted in the past that I think one of the achievements of your team and Secretary Geithner was to reverse that position, that the stress tests were effectively a reversal of that. I would like you to address what other steps you're taking to, shall we say, reverse this confidence deficit, and with particular reference to what plans you have to be forthcoming about the destiny of these large banks that were the subject of this essentially misrepresentation, according to Mr. Barofsky, around their health.
Well, first let me make clear that as we expressed in a letter that I sent to Mr. Barofsky some time ago, we fully share his concern that the government operate with transparency and accountability, and that's guided us during this administration. And we have published voluminous information about the TARP program on our website, financialstability.gov, about the lending practices of the banks, about every transaction that we've done, about the models we use in valuing warrants and valuing our investments. We're going to be reporting a full accounting of the value of these investments by the end of this year, so that the public can see for themselves what the returns have been on the money they've invested through TARP. So we're trying to be as open as possible. I have dialogues with Mr. Barofsky every week, and sometimes more than 1 week. Like this week, we met several times, and we are, I think, share the same goal, to try to protect the interests of taxpayers while also promoting financial stability. And we have adopted at least 3/4 of the Special Inspector General's recommendations, as we have your own recommendations, which we welcome, and the GAO and the Financial Stability Oversight Council. So we are trying to be as open and responsive as we can possibly be, and we understand our substantial responsibility to the American public.
Mr. Neiman?
Thanks. To give you a heads up for our future reports,
Okay.
Our December report, we're going to look back over the last 12 months and really look at how effective, what are the measurements, what are the metrics that we should be looking at, what measurements the American taxpayer should be looking at to see the state of the economy and the effectiveness of the Treasury's program. And credit availability will be an important part of that analysis. And as you know, though, measuring credit availability in this environment is very complex. And we know that credit contracts in a recession as banks and consumers deleverage, and we know that underwriting standards become tighter as banks strive to conserve capital. So, you know, I'm looking to you as we grapple with this question. What should the American taxpayer, how should they be assessing the effectiveness of the Treasury's programs to promote bank lending? Should they be looking at credit spreads or bank origination levels or portfolio holdings? What would be helpful and meaningful for the American taxpayer?
Yes. Thanks for your question. Actually, we do a lot of thinking and work on that subject. We have many different measures that we use to assess the effectiveness of these programs and also the activity in the financial markets. And we'd be glad, by the way, to sit down with members of your staff to go over our metrics as well as you produce your own report. But I have to say that, you know, for all the measures of debt spreads and prices and what have you, capital ratios, what counts to the American public eventually is going to be, is the job market getting better? Can I afford to stay in my home? Are businesses able to get credit? And even though these programs have helped to alleviate these problems, we're not by any means satisfied. And we have to keep on striving to make these programs as relevant and as useful to the American public and to produce real results as possible. And that's why we're altering the thrust of the TARP program today from having helped the large financial institutions survive, which was important to the financial system given their role, but now get into what's happening with the American public. Can the small businesses get capital? Can small banks be helpful? And can people stay in their homes? So that's where we're focusing our effort today. So we can give you the financial metrics, the more sophisticated measures that we use, but I think ultimately these programs will be judged by their impact on the American economy as felt by the American public.
Are there any plans to expand the monthly lending snapshot? I know you've extended it beyond the largest 19 to include 200 banks, though it is a monthly snapshot. I've been recommending for a while that it should include trend information, comparisons to earlier periods, such as 2006 when credit was running high, and even the fall of 2008 when credit markets were frozen. And I think that would give those kind of trends would provide perspective for the American public as to where we are in comparison to where we were.
I think that's a great suggestion. Let's see what we can do there.
Great.
Thank you.
Mr. Assistant Secretary, thank you very much. Thank you for your time. Thank you for your service. We appreciate your coming here today. The record will remain open for questions, additional questions from the panel and from our members who couldn't be here today. And with that, this hearing is adjourned.
Thank you very much.
Thank you.
The financial system is failing to play its proper role in supporting the real economy on Main Street. I am interested in the immediate steps Treasury is taking to counter this perception in areas like executive pay, But the real test will be whether we really repair the banking system so that it can function again, or whether we repeat the unpleasant experience of long-term economic stagnation Japan went through in the 1990s. Again, I look forward to hearing from your testimony this morning, and I again extend my thanks to you for joining us once again.
Superintendent Neiman.
Thanks. Mr. Allison, thank you very much for being here today. You know more than anyone how important today's hearing is to the American public. It was about a year ago that the U.S. government told the American taxpayer that the financial system faced possible collapse if taxpayers did not provide $700 billion to rescue it. The taxpayers did what was asked, and they did it even though it meant swallowing what some perceive as a very bitter pill. I also don't have to tell you about the reluctance and, in some cases, the outrage of providing financial support to some of the very institutions that helped cause the crisis, many of which pay their employees more money in 1 year than many Americans make in a lifetime. So the stakes of the effectiveness of Treasury's use of that $700 billion are very high. Treasury's programs have to work to stabilize the financial system, but they also have to work so people feel they have also gained from this massive capital infusion. Treasury's programs must restore credit for small businesses that promote entrepreneurship and create jobs. And the programs must keep people in their homes by preventing avoidable foreclosures. Success in these endeavors goes beyond just restoring confidence in our financial system. Success is critical to maintaining confidence in our democratic system. Remembering back to our first meeting with Secretary Geithner in April, I'm glad to say that we can have a different conversation today than we had then. The Department of Treasury deserves credit for making substantial progress. We are by no means out of this crisis, but yours and Secretary Geithner's efforts averted a disaster, and that should be recognized. But our gains remain fragile, particularly as they apply to the people who need Treasury's programs the most. As you and I discussed in our last meeting together over the summer, it is critical that we redouble our efforts to help the millions of homeowners facing foreclosures. I am grateful to the Treasury and to you personally for participating and arranging the participants at the hearing last month in Philadelphia. It was the first time, to my knowledge, that Treasury, Fannie Mae, and Freddie Mac came together in a public forum with housing advocates and mortgage lenders to discuss the progress of the administration's foreclosure prevention programs. I intend to follow up on several of the issues that came out of that hearing with you today. I also intend to ask you about improving access to credit for tens of thousands of small businesses that employ the vast majority of our economy's workers. I'd like to commend your office and the administration for announcing initiatives just yesterday to provide capital for community banks.
The Treasury Department said remaining funds from the so-called TARP program would be focused on helping small businesses and the housing market. Herb Allison is the Treasury official overseeing the program. He testifies before the Congressional TARP Oversight Panel for about an hour and a half.
This hearing of the Congressional Oversight Panel is now in session. I'd like to start by welcoming you, Mr. Allison. The first time you came to see us, you had been in your office for 1 week, and yet already we're full of information. And so we're glad to have you back and hope you'll be able to update us on TARP. As you know, TARP was able to accomplish direct and immediate help for the largest financial institutions, but smaller financial institutions, small businesses, and homeowners facing foreclosure have waited much longer and received much less help. People who funded the bailout, the American taxpayers, are bombarded with news that Wall Street firms that benefited from TARP with windfall quarterly profits are now preparing to reward their executives handsomely with hefty bonuses. That, on the other hand, unemployment remains close to 10%, loan defaults continue to rise, and the foreclosure crisis has no apparent end in sight. I worry, not only because of where we are in this crisis, but that the factors that led us to this crisis have not yet changed. The financial sector that we talked about a year ago as too consolidated, too big to fail, is more consolidated than it was back then. When we talked about toxic assets on the books of the banks, those toxic assets remain on the books of the banks. There's little to inspire confidence in the balance sheets of the banks, and the health of small and mid-sized banks remains a very serious concern. That concern is doubled because they are truly the lifeblood of small business lending. 99 of these banks have failed so far, as you know, and we have more than 400 on the watch list, and many are dangerously overexposed to commercial real estate. We continue to face a grim picture. On regulatory reform, the very rules that will change, that will prevent this crisis from happening again, that process is just starting. So I think taxpayers are concerned about what this means for their economic security. We hope you can provide some answers today and put TARP in the proper context and help us understand where we go from here. The panel's core mission, as always, is to ensure that TARP operates with transparency and accountability. We thank you, we thank your staff for working with.
Written statement, so we'll only touch on two of them now. First, the panel recommended several areas to improve HAMP effectiveness and transparency. Treasury recently released guidance that streamlines and standardizes the paperwork needed for a modification. To make the process more transparent for borrowers who've been turned down for a modification, we've established denial codes that require servicers to report the reason in writing to Treasury and soon to borrowers as well. We're also improving transparency of the net present value, or NPV model, a key component of eligibility, by increasing public access to the NPV methodology and encouraging a wider understanding of the model among housing counselors and borrowers. Second, the panel recommended that making home affordable should try to address a wider population, including borrowers with option ARM loans with negative equity and those who are unemployed. Treasury recognizes that these situations can be particularly challenging. As the panel's report reflected, our current program does permit borrowers with pay option ARMs to use HAMP when they meet other eligibility criteria. HAMP can also help homeowners with negative equity to reduce their mortgage payments to affordable levels with a hope for homeowners refinance from the servicer if the borrower qualifies. Finally, as the recession deepened, unemployment became an increasing contributor to the ongoing foreclosure crisis. Therefore, unemployed borrowers that will receive at least 9 months of unemployment benefits are eligible for a modification under HAMP. As our efforts progress, we will continue to study ways to meet the challenges of reducing total foreclosures. We're pleased to be winding down certain TARP programs, but recognize there are lingering weaknesses in housing markets and small business lending. We remain committed to helping American families and small businesses and building a broad economic recovery. Thank you, and I look forward to answering your questions.
Thank you, Assistant Secretary Allison. We appreciate your remarks. I must say I am encouraged to hear that Treasury is talking about winding down large parts of this program and shifting much of its focus to foreclosures and small business lending. I will be even happier in the day when we're put out of business because this process is complete and there is no more TARP. But this also changes oversight, obviously. We have to go where you go. So let me focus first on foreclosure and the foreclosure mitigation programs, if I can. I just want to make sure that we're kind of tracking here. We put the numbers together, as you saw in the report, suggesting that the current mortgage foreclosure mitigation program or programs, when they're fully operational based on the most optimistic assumptions that Treasury has given us, that nonetheless foreclosures will likely outrun modifications by about 2 to 1. Does that fit with the numbers you're seeing?
Thanks for the question, Chair Warren. I think we have to keep in mind
that are substantial lenders to small businesses. 1 year later, the financial system needs to start working better for small businesses and for all Americans. I look forward to our discussion.
Thank you, Superintendent Neiman. Congressman Hensarling, I hope will be able to join us later, and Mr. Atkins, our fifth panelist, is traveling and not able to be with us today. So that concludes the opening remarks of the panel. Mr. Allison, I recognize you for 5 minutes. Your entire written statement will be made part of the record, but if you could take a little time, no more than 5 minutes, to bring us up to date, I think that would be helpful.
Thank you very much, Chair Warren and members of the panel. Thank you for the opportunity to testify today. I welcome this occasion to update you about the progress we made in restoring financial stability and to discuss the impact of TARP programs. The government actions taken last year, including the first phase of TARP, are widely acknowledged as helping to avert catastrophic failure of our financial system. When President Obama took office, the financial system was still extremely fragile, and the economy was contracting rapidly. Measures taken by the Congress and this administration have helped bring stability to our financial system, are assisting responsible homeowners, and are getting credit flowing to consumers and businesses, all at a lower cost to taxpayers than was anticipated. With these improvements, it is time to set a new direction for TARP. We will begin to wind down and terminate TARP programs that were launched at the peak of the financial crisis, and cap programs to purchase legacy assets and to securitize credit at lower levels than anticipated. Now the administration will reshape targeted assistance to the key challenges of helping responsible families keep their homes and helping small businesses get better access to credit. Yesterday, President Obama announced new steps to improve access to credit for small businesses by providing lower-cost capital to community banks. Small business lending represents 56% of business loans from small banks, compared to only 21% from larger banks. Therefore, community banks with less than $1 billion in assets will be eligible to receive new capital at an initial dividend rate of 3% when submitting a plan to increase small business lending. The corresponding rate will be 2% for community development financial institutions. In the coming weeks, Treasury will work with community banks and the small business community to finalize program terms to best support small business lending. The other continuing focus will be our efforts to help responsible homeowners. Treasury's Home Affordable Modification Program has now provided immediate relief to more than 500,000 homeowners who've entered into trial mortgage modifications. Families in permanent modifications are saving over $500 a month on average, as this panel noted in its October 9th report, an assessment of foreclosure mitigation efforts after 6 months. The panel made a number of findings and recommendations in that report. I've tried to address them in my
with us very closely on that, and we look forward to hearing from you today. And now I call on the Deputy Chair, Damon Silvers, for an opening statement.
Thank you, Chairwoman Warren. Good morning. It's a pleasure again and an honor to welcome you, to welcome Herb Allison with us, to be with us. I am very grateful to your willingness both to appear before us in these formal settings and the extent to which you and your staff have been available to the panel informally since you arrived at Treasury. This hearing convenes as the Office of Financial Stability and the Treasury Department and the administration more broadly are undertaking a number of initiatives that appear to be efforts to respond to concerns raised by, among others, this panel regarding the provision of credit to business, particularly small business, the continued excessive and, at least to my mind, somewhat perversely structured executive compensation at major TARP recipient institutions, and finally, as our chair referred to a moment ago, the continued escalation of the home foreclosure crisis. While my sense of these initiatives is that they are all directionally correct, I look forward to hearing today about the scope and design of these initiatives in some greater detail. Now, I also want to compliment you, Assistant Secretary Allison, on the OFS's handling of the cancellation of the Bank of America asset guarantee. Bank of America clearly benefited from the perception on the part of the markets that this guarantee was effectively in place for a time, and it was only appropriate that it should pay a fee for having done so. I don't think it was a foregone conclusion that that would in fact occur, and I attribute that to you and your staff's leadership, and I think you should take some public credit.
Thank you.
However, I remain extremely concerned that as a result of having a strategy with the TARP program that is fundamentally about buying time in the hopes that the financial system will earn its way back to health, that we are at risk of a vicious cycle. Persistent high unemployment, in part generated by the initial financial crisis, breeds more foreclosures and a continuing housing depression, which in turn keeps our major financial institutions weak and causes continued high rates of failures of small banks. Weakness in the banking sector then threatens to act as a powerful headwind, preventing the revival of employment outside those firms that can access the public debt markets. We discussed this matter with Treasury Secretary Geithner when he last appeared before this panel. With this concern in mind, I hope that you will be able to discuss with us, with some specificity, the current state and future prospects of the largest financial institutions that are continuing recipients of TARP assistance, and I believe are at the core of the threat of continued headwinds from the financial sector, those being AIG, Citigroup, Bank of America, and Wells Fargo. I recognize, of course, that AIG is a special case. Ultimately, the Wall Street bonuses that got so much attention this past week make tangible and specific the growing feeling among the public that we are back to business as usual on Wall Street, while the financial